This is Tim Petry, NDSU Extension Livestock Marketing Specialist. Today we're going to talk about some price outlook for backgrounding cattle and also some price risk management. Just a word of caution here is that I'm taping this on November 3rd, and the market is quite volatile now and has changed quite a few dollars. We'll talk about that in a minute. If you're watching this several weeks later, the market may be much different than it is now. So let's just get into the starting off here again. Most of you are aware that the market has really been volatile lately, particularly the futures market, and we'll talk about the cash market in a minute. October 16th seems to be the date that it turned around, and right away we're going to talk about the futures market and then get into the cash market lately. But the futures market has been going up the entire year, and in fact, cattle prices have been going up for several years and are at record high levels. But anyway, the all-time record high, I'm just looking at the top on the December 25 live cattle futures, peaked out there on October 16th and have declined since then. When we get to talking more about it, the biggest thing that affects cattle prices, feeder cattle prices in particular, that we're going to be talking about today is that it's the live cattle futures in the distant months when those cattle will get out of the feedlots and be market beef, and then feed prices, and then supplies. And so we'll talk about all those. So the futures market is important, is an important part of the picture for feeder cattle prices. But again, peaked out on October 16th, have declined since. And really what sparked that is in the looking at the chart in the bottom left-hand side there, the President Trump said, I think we have a deal on beef that's going to bring the price of beef down. That would be one product that we'd say is a little bit higher than we want it. And that kind of put the shock into the market. That wasn't the first time he said that. You can go back just under the T on futures there on September 9th. He said the same, he just casually kind of said the same thing, that beef prices are too high and I'm going to get them down. But, that was about it, and nothing really happened there. And so we went on, and then of course October was just a tremendous month for prices there, again up at record high levels, and I'll talk about more of those when we get into talking about the cash market. But then what I want to visit with you now is the uncertainty and what has happened since October 16th and why the futures market went down, and ultimately we'll see then the cash market has went down too. So what happened then, as he said that, and then the Argentine president was here, and Trump it was trying to help Argentina out, and so he made a deal that we would possibly increase their tariff quota on beef. They have a quota now of 20,000 metric ton, and he was going to said that we would raise that to 80,000 metric ton. That would then keep tariffs lower. There's still a little tariff on beef in that tariff rate quota, but after they meet the quota, if they want to ship more beef, then it goes up significantly, and so then that would allow them to allow more beef in. So anyway, still a lot of questions surrounding that. Is will they even send us much more beef, even though we raise their quota? Because a lot of their beef, the majority of it goes to China now. Prices are higher in China than they are here, so would they send them here? And that's a big question. But again, that's kind of the first thing that got the futures market traders. And again, the investment funds have been buying futures throughout the year because, the trend is their friend, and the trend has just been up, up, up. And so, then what happens when something sparks the market down, then they have their stops on the market, and with the algorithms and so on, then it just, one after another goes down, and that's basically what happened. There were a lot of other issues here. The futures market does not like uncertainty, and usually the futures market, when they're trading with the trend, it does have a tendency to go too high based on fundamentals, and on the other hand, too low based on fundamentals. So, some people would argue that's bad. Others would argue it's good. It allows price risk management at prices higher than might be available if you're wanting to sell, or on the bottom side, you lower prices to buy in at. And so that's again a subject for a future talk. But anyway, there are other issues going on too. The Mexican border is closed now to cattle. We'd be getting about 30,000 more on that in a minute. I've got a slide to show you 30,000 feeder cattle in, and you know, negotiations have been going on and are going on with Mexico because they do want to get that border back open. Another thing that's going on right now is a talk of the Brazilian tariffs. We have a 76% tariff on Brazilian beef at the present time, and they're negotiating all right as we speak to get that back down. We have a tariff quota on Brazil as well. And then another thing is the China trade agreement, which now just yesterday was announced that we do have an agreement with them. Details are not there, but that would be actually positive for prices if we could get an agreement with China. But all these issues are causing a lot of uncertainty in the market, in the futures market in particular. So therefore, you see that, you know, the cattle futures went down, you know, over $20 a hundredweight. Now they've came back down, are down 16, and even the distant futures, if we, you know, get into later ones, even went down a little more than that, 25 to $30 and so on. So that's one of the conditions of feeder cattle prices is those distant futures, when feedlots could lock in a price for the feeder cattle they buy. And then on the bottom, feeder cattle futures have followed down as well, and actually on a dollar basis have went down even more. You know, at one time down almost $50, but have recovered now to about most of the futures are down about $40. That's important for a backgrounding as well as if we want to do price risk management into March, and more on that in a minute. So all the uncertainty has caused the market to go down, and that usually happens when we're at record highs and so on. So let's just move along. Again, the three biggest things that affect feeder cattle prices are supplies, and then the price of feed, and then the price of fed cattle, particularly those distant futures when those feeder cattle would finish. So to begin with, I think probably most of you are aware that from a supply standpoint, we have very, very low supplies. On the top is our calf crop in 25, the lowest for many, many, many years, as on the chart there, just goes back to 2007, but you know, a declining. Our cow herders went down for 6 straight years, and so obviously a lower calf crop. So we've got fewer calves to sell. The July 1st inventory report that USDA put out is also showed July 1st feeder cattle supplies outside of feedlots, again at very, very, very low numbers there. They didn't have a report last year to compare to, but so the bottom line is our supplies are historically low, and that's supportive to prices and the reason why prices have went up as much as they have. Looking at fed steer prices then, and again, here is the cash market, the 5 market area market, and that has been at record highs. You know, just back there in the midsummer, up at 244.25 was the high, and you know, we backed off seasonally like we usually do after the summer big beef grilling season over, go down, and then they tend to spark here like they did until October 16th a little bit as the holiday marketing season comes. But anyway, we're still there last week at 231, although we've backed off about $9 here in the last couple of weeks. It's still kind of historically high. Then, of course, important for feeder cattle prices are those distant futures. And so, you know, going into the next year, those gold squares there show the futures market. And again, that's backed off $20 or so. And so that's affected feeder cattle prices, and that the feedlots could get a lower price there. But still, from a historic standpoint, at least the first part of the year, even above last year, and the futures market is kind of risk off for when we get into June and so on, but still outside of the prices this past year, and they can do better than that if if demand holds and we get all these trade issues settled and so on. But USDA is actually their last estimate, and they haven't made an estimate because of the government shutdown. They were expecting prices next year to average about $240. But maybe they will lower that. We'll have to see when the government opens up. But still, uh, relatively high prices of feeder cattle on a historic basis, short supplies. And then the other part of the picture is feed prices that have been low. They're and my charts here are going to be all the same, where red is 2025 and blue is 2024, and then purple is 2023, or it's a 5-year averages. We'll see some of the uh, when we look at the different market classes. So, corn came down quite significantly in 2023. We had a big crop in 2024. Now this year, USDA is projecting an all-time record 16.7 billion bushel corn crop. And so, our expectation then is that corn prices will, stay at the levels similar to what they were last year there. And again, that's supportive to feeder cattle prices, because if you look on the top, we changed corn 10 cents a bushel, changed calf prices a dollar in the opposite direction. So, we're getting support from feed and lower supplies, and then relatively high fed cattle prices. Well, and then the other thing, when we're talking about backgrounding, the reason why we background calves up here and then send them to the feedlots in Nebraska or Iowa or southern Minnesota or whatever is because our corn prices are cheaper. I use Omaha corn prices here in my chart that last week averaged 405, and yeah, they have came up a little bit since earlier, but still again near last year's levels. But here's a bid from today from an ethanol plant in central North Dakota, bidding 372, which is you see less than Omaha prices. So we background our calves up here with the cheaper corn that we have, and then send them down there to be finished. So a lot of support to feeder cattle. And getting into feeder cattle again, I just want to mention a little bit about that feeder cattle imports from Mexico are not allowed at the present time because of New World screwworm. So you see on the bottom of the chart, since May there, we haven't gotten any in. And looking at the chart, normally this time of the year, we'd be getting 30,000 or so. And a lot of those calves would go on winter wheat in the southern plains, and the winter wheat crop down there is the best that it's been for grazing for many years. And so there's a big demand for calves to put on there because of very cheap grazing, because that wheat is just going to go dormant anyway compared to up here when we have to background calves with the feed we have. So that's been supportive. But again, that's another thing that's riling up the market, is whenever there's a rumor that border may open up, and it is going to open up sometime. We just don't know when. So that's causing more uncertainty in the market. So when we go then to our 550 to 6 weight steer calves now in North Dakota, and so this would be the calves that we would price in to the market, to a backgrounding program. You see the red line there again this year. We've just been up, up, up. And, there by the 1st of October and into October, many, many, many important fundamentals just caused those record high prices. We're even now, even though we've went down since that spike there into to October, the 1st of October through, and then since October 16th, we've mid-October we've went down a little bit, but we're still higher right now at 437. These are USDA prices that are quoted for North Dakota at 437. We're still higher than the 427 on October 1st, although yeah, we've came down almost $50 from that really sharp peak at into early October to now. So calf prices are compared to last year when they were down there about $300, now 437. They're $137 higher. And so all the reasons showing up there, we have had strong fed cattle prices, a short supply, the Mexican border is closed. We are retaining more heifers to rebuild the herd because the weather is better there and the price are signaling that. We have very good winter wheat, new feedlot capacity, just building a new 150,000, finishing 150,000 head capacity feedlot in southwestern Nebraska. And even now they're talking adding another 50,000 on that. So we've got new feedlot buyers and low corn prices. So that's the reason why we have prices there. And so going to the heavier weight prices then, which would be the steers coming out of a backgrounding program, again, kind of the same story there, just at all-time record highs up until October, but now, again, have backed off seasonally. They do usually peak out in September and then go down, but with all the turmoil in the futures market and so on. And the big thing from a background standpoint here is then looking at those feeder cattle futures, particularly let's go out into March there, that in the last couple of weeks you saw that the feeder cattle futures market has went down, and so we were up there around 375, and yesterday on the March futures closed at 332. So we're off about $40 from a price risk management standpoint of what you got before. So that's going to be margins are going to be narrow there. But again, I'm urging you to watch the other video that's available from Brian Parman, and he's going to talk about budgets. And the calf prices in now have went down a little bit from their highs, but fed cattle have, and so on. So it'll be very important for you to look at his budgets, because if we're going to use price risk management, we have a lower price level now than we had a couple of weeks ago. But that doesn't mean that we can't background cattle, because it's a margin business and you have to look at your costs and then the expected price and so on. But yes, those spring futures that we would could hedge into or could price risk management into, are certainly off what they were up in October 16th. So a little bit about, here's our last market report that came out from USDA then today. And so I want to talk about it. I'm not going to go through all these prices. Just in the upper right left-hand corner there, it kind of says, compared to last week, steer and heifer calf prices are off $15 to $30. So that means that when we price them in, that they are cheaper. Go down to the middle of the chart there, circled in purple then, as typically we would put 550 to 6 weight steer calves into a backgrounding program, and circled there on the right hand side is that they did average for almost 437 a hundredweight at all time or for this time of the year, an all-time record high. Again, they were higher all the way up 2 weeks ago. I think we're around 480. So yeah, they've backed off significantly, but that was a very sharp up and down peak as we saw before. So one of the things I want to mention is the range in prices there is huge. A $61 range in price for the same weight and grade of steers at the same markets there, from 403 to 464. So I guess the take-home message there is, if you're selling those calves, do the appropriate things to get them at the top of the market, and a lot of factors affect, besides just the grade, affect cattle, and you're well aware of that. On the other hand, there were some selling for 403, and so from a background standpoint, maybe you could go, instead of getting those very top steers that maybe that are being sold up in there, the 450s and 60s, you could go down a little bit closer to the average and maybe add value to them and lower your in cost if you're buying. On the other hand, if you have your own steers and know about what they would bring, that's the price you would put into your backgrounding program there. The other thing as we go down is, think about it when you're backgrounding, is that don't get the calves too fleshy. I know we want them to gain, and yeah, we want them to gain 2.5 to 3 pounds a day or so, but don't push them really, really heavy, even though corn is cheap and you might have a lot of it. When they get fleshy, then you see a discount that can be, $20 or so. They're shown on the chart. So, have them gain. That's well and good, but just don't get them too fleshy, or you're gonna, kind of defeat the purpose. The other thing that Brian's going to talk about is he's going to give you some heifer budgets, and usually I don't know what his budgets look like, but the heifer budgets usually do show more profit potential in some cases than steers because they are heavily discounted. The same weight and grade over steers right now, 550 to 6 weight heifers averaging last week they're at 385 or $50 lower than steer prices, and every 50 pounds they gain on steers up until slaughter weight, steers and heifers are the same price. So the more weight you put on heifers, I know there's management issues and so on there, but look at his budgets there. And for some of you, if you're buying cattle or even with your own heifers, there's probably potential in feeding heifers. So uh, looking here then, hindsight is 2020. We've seen what the market has done and a lot of things affecting the market and a lot of trade agreements going on now and so on and so on. And so I think we really, if you're buying cattle in particularly, need to look at the price risk management because we don't know what the market's going to do. Just if nothing else, look at what it's done in the last 2 weeks. And that should be a signal to you that, depending on your equity situation and so on, then maybe don't throw price risk management out the window and be sure to look at that because, when prices are high like they have been and are now, volatility is high, and we've just seen that in the last 2 weeks. There's always a risk for lower prices. We don't know what's going to happen with all these trade issues and so on. So I think when we're in this part of the price cycle and the upward part of the price cycle, is we should find a price risk management strategy where we lock in a floor price and leave the top side open. Two ways to do that are with a livestock risk protection insurance or futures market options. And so I just want to, in the last couple of slides here, just some of you may not know about livestock risk protection. And so I just kind of, hit some high points of that. It would take me 50 minutes to an hour to explain that, and I'd sure be happy to do that. And if you want more on that, you could see your extension agent and set up a meeting, and I would be happy to do that. But, again, here's the March feeder cattle futures, and yes, they have declined quite abruptly, and so that shows you the volatility we have now. They have came back in the last week, and we're up $5 yesterday, and they're still below the cash market. That green line is the CME cash settlement index, which the futures close at, and we'll look more at that in a minute. But the livestock risk protection is based on the futures market, but you get settled out when your contract matures at that CME cash index. So that's important that we show that. And it's the cash market as of yesterday was about $10 higher than the futures, and probably one of the reasons why the futures now are adjusting back up and coming back up when the dust is settling a little bit, but still a lot of uncertainties there that might cause price risk management. So for LRP feeder cattle, we're just going to concentrate on the purple beef cattle there, and you can do two contracts there for steers and heifers, 100 to 599. But what we're interested in backgrounding would then be the 600 to 1,000 pound contract. So you can do either a beef steer or heifer contract. Available for about a year out on a monthly basis. Right now, if say we're backgrounding into March, today's LRP, a March 2nd maturity would be the 17-week contract, and then you can get them, a month later, you could go all the way out till next November. But here we're just talking about backgrounding into spring. So those policies are available. And the beauty of livestock risk protection is that you say the number of head that you want to do from a minimum of 1 on up. And so you don't have to do them all at one time, and you can do some steers and or heifers and put a few on and do it that way or whatever. But again, it's between you you and your lender and the risk that you want to take and so on, and how much price protection do you really want there. So for these heavier weight backgrounded feeder cattle, then the LRP, that price, the closing price or the price you get is based on the CME feeder cattle index, which I just showed you was that green line on the chart is for all 7 to 8.99 pound medium and large 1 and 2 feeder steers sold at all the markets reported by USDA, including North Dakota all the way down through Texas. The current index as of it's always a day late. So yesterday, the Friday's index was 343.33, and then today's will be computed tomorrow, but it's at 343.33. So a little bit about, the index and how it's computed and so on. The CME just puts it on their website every day of all the markets reported. I just go back to the 30th because that's when actually Napoleon is also reported, but their sale was small enough where the reporter did not go to Napoleon, but Dickinson was reported there. But there were all the markets that were reported on the 30th. So we go down to the bottom right-hand side. The average price for that day was 346.63, but it's a 7-day moving average is the actual index price is 347.25. So for all LRP contracts closed out on October 30th, they would be closed out at 347.25. Now, if you go up to Dickinson, you see prices were quite a bit higher than that. And one of the reasons why is because they had all the ones they didn't, they just had the lightweights in 35 that averaged 725. They didn't have them all the way up to 899 pounds there. So and so, but price is higher, and usually our basis for those 700-pound cattle are higher than the cash settlement price, because the cash settlement price would be more an average of 800 pounds there. When it's 7 up to 899 pounds, the average would be 800, and that's what you see. They're averaging about 800 pounds there. And so for our backgrounded cattle to come out about 850 pounds or so, we would be closer to what a par basis with that cash settlement price. So here then is the offerings that we had today that came out at 3 o'clock today. They come out at 3 in the afternoon and are good till 8:30. So they'll be good until 8:30 tomorrow, Tuesday morning. And yeah, there is sticker shock when you look at them because, high prices, our premium is based on, how far out you go, and then the actual price locked in. So, the top offering for March 2nd there, and every day it'll be a day later when they come out. Tomorrow they'll be the birthday date will be 303. But anyway, you could get a $333.26, which is about what the futures down in the bottom lower part you see there. Futures closed at 332.52, and the offering from USD was 333.26. However, the producer premium there is 12.68. So on an 850 pound steer, that's $107 a head. So you have to put that into your budget. And again, Brian Parman is going to talk about that. But you don't have, what's important for you is to figure your break-even price. And your break-even price may be lower than that. It may be 320 or 3. It depends on your corn price and your lot price and everything else. It could be lower. So, you could go down there all the way. You see, by the time you get down and lock in a 308, it's down to $43. So again, you got to figure your break-even price. Look at your budget, see how much, talk to your lender, see how much risk protection you might need there. So just finish up then. Again, there's a lot of uncertainty in the market now. And if you're buying cattle, you're going to pay the most you ever have for them, or for your own cattle, the opportunity cost of selling them in the market is the most they've ever been. They're high. There is risk there. And so again, you need to know your costs, consult with your lender, and certainly I would encourage you to at least consider some price risk management on some of them. So that's all I have for you today. If you have questions, my email address is there. Feel free to get a hold of me. And again, if you would like more information on LRP, if you would see your county agent, we could set up a meeting. So with that, again, be sure to look at Brian Parman's stuff there.